The announcement was always going to be finely balanced, so going in expectations were 60-40 for 25 versus a 50. Of course they delivered 50 today, but I think either outcome was easily justified. Obviously in the Reserve Bank's minds they'd be balancing the confidence that inflation is going to be under control over the medium term versus the risk that consumers and businesses will remain overly cautious, and that will continue to weigh on economic activity. Yeah, I think there certainly was a surprise in the review. And, the Reserve Bank effectively achieved a bit of a shock and awe that they'd be probably quite happy about. And this is certainly evidenced, when you look at the fall in short-term interest rates with them down, 10 or 15 basis points, depending on where you look in the curve. Also, the New Zealand currency is quite a bit weaker on the crosses as well. So, if we go back to August when the Reserve Bank, took a more dovish stance, both in terms of their actions and their rhetoric, we've really seen them sort of front-loading that with a 50 basis point rate cut today. The market had largely priced this in, but I still think, when you look at the reaction, people didn't fully expect it to happen. But look, it is a good thing, and it increases the chances that we will see a meaningful recovery in the New Zealand economy, although it's not going to be a V-shaped bounce. Hopefully the data will start to improve over the next 3 to 6 months. So we've had the funds positioned long duration versus benchmark for some time now, for the expectation that interest rates would continue falling, and that's largely because we haven't seen a meaningful improvement in the underlying economic data. So our base case was that the Reserve Bank would have to do more to try and stimulate the economy. So we've been buying longer maturity assets to effectively lock in those higher yields for longer, and when rates fall, effectively we get a capital gain. Our expectations are from here that maybe rates might go a little bit lower, but we think they will stay at low levels for some time. So what we've done so far is done a good job, but then we're thinking about if interest rates are going to be stable for the next sort of 12 or 18 months, how do we maintain that higher yield on the portfolios, which has proved a consistent value add over time. Most commentators in the Reserve Bank have been surprised or perplexed about just how difficult it has been to try and reinvigorate activity in the New Zealand economy. Obviously, consumers and businesses have been very cautious, and maybe New Zealand's been one of the weaker economies in the world, and probably one of the reasons for that is perhaps we've all misjudged just how important immigration, house prices, asset price appreciation, and also tourism is to the New Zealand economy. So last week we did see some further relief in mortgage rates, that they moved a bit lower, but of course this was largely a result of competition. So banks have been struggling, I guess, to lend money in this environment. So that's why they've shifted rates lower. Of course, the Reserve Bank since August have come out and they've said that they'd be happy that if lower interest rate settings were passed on to borrowers. But I think going forward, this still largely resides in the actions of banks, and that'll be a competitive response. So look, maybe mortgage rates could go a little bit lower from here, but we're probably talking 20-30 basis points rather than 0.5% plus.